there is an incredible demand for content around zero DTEs. And in my opinion, nobody does it better than us. So let's take a look. The whip. Oh, no, go back. We called this today the whip factor of zero DTE IV. The whip factor of zero DTE IV. Let's take a look. So whenever there is an uptick in implied volatility, nearer term implied volatility tends to rise above longer term implied volatility, making the 0 and 1 day to expiration option prices the most sensitive to large changes in implied volatility. That's pretty, most tasty traders have become, I think, pretty familiar with that at this point. In a long-term play in volatility, we would call that backwardation. In a short-term play, all it means is, hey, there's a lot of risk tomorrow for whatever reason. It could be some big economic number, right?
True. And it was XFL, not USFL.
Oh, XFL. You're right. Mm-hmm. But it could be some big economic number, right? It could be some event, political event like an election. It could be Brexit or something like that. But there's lots of reasons why on a specific date, one day could be in front of something else. If the entire market, like if the near-term volatility in the market gets higher than back month volatility, then you've got a much bigger crisis going on. Like in 2008, front month volatility got to be as much as 6 volatility points above back month. In 2020, in the pandemic, front month volatility got to be 5 or 6 handles above back month volatility. That's true economic panic that's way bigger than a one-day event. That's something happening that the market's not really able to price short term, so it doesn't know what to do, so it makes these really crazy volatility adjustments. But on a one-day basis, it would be something like, hey, the Fed's coming out tomorrow, with a big number or something like that, all right? So all that stuff considered, since we're doing 0 and 1 DT options here, this is a little bit different story. So we're looking at what would happen on a 1 day basis, right? That's all. Yep. So what we're showing here is the 1 day, 2 days, 5 days, and you can see how in the short term, if you can, hopefully everybody can read that. It's the 1 day is 18, but you've got 18, 19, then you go drop down to 15, 16, right?
Yeah. It's clear on the screen. You can see it very easily.
Yeah, it's not huge. All it does is impact whatever the expected 1 day move is, but it just shows you that there's a little more sensitivity to what's happening in the very short term. Mm-hmm. Let's go next slide. So because all implied volatility durations from 1 day to 90 days are correlated, how sensitive are the various durations when the normal VIX, the 30-day implied volatility, moves up or down? So IV indexes are derived from real option prices, which means this study will tell us how much more variance exists in option prices of various durations solely due to changes in implied volatility. That's kind of interesting. Let me read that again. The implied volatility indexes are derived from real option prices. We talk about that all the time, which means this study will show us how much more variance exists in option prices from different durations, solely based on implied volatility. Let's go to the next slide. So we looked at the 1 day VIX. It's not tradable, by the way. The VIX 1D is not tradable. The VIX 9D, these aren't tradable, are they?
You can trade VIX, Thomas.
Can you trade VIX 1 day?
Sure. Hold on. Yeah. Well, I mean, it depends on the cycle. Like right now, you have 5.
Oh no. You can do that, but there's no VIX 1 day.
VIX 1D? No, I don't believe so.
No, I don't think so either. It's just the VI. You're talking about the VIX with 1 day to go.
Yes, that's correct.
Yeah. Sure, of course.
Yes.
Yeah. So we decided to look back. We went back to September of 2022, and we compared the effect of changing the 30-day implied volatility on varying durations. How much more does the VIX 1 day move? How much more does VIX 1 day move when there is a big move in the 30-day implied volatility? Okay. So we're just comparing what happens when 30 days move to, to the short term. How much does it impact us? Right.
Okay.
Let's go to the next slide. So here's where we get into the meat. On any given move in the VIX, 1 day implied volatility moves 3 times as much on average.
Wow.
Okay. So let's say the VIX is, where are we today?
19 right now. 19.
What is it?
19, 1%, 19.
1%. And the VIX futures haven't moved much today, but they've only moved like a nickel. But the VIX, what we're saying here is that given a 1 day move in the VIX, the 1 day implied volatility moves 3 times as much. So the convexity drops to just 1.3 whenever duration increases to 9 days. So this whip effect is symmetrical for both up and down days in volatility. This is very interesting because we've never looked at volatility this way, and we've never looked at what the research team is calling like kind of the whip effect, and the fact that it is symmetrical to the upside and to the downside. So you can see here, any up move in the VIX, the 1 day is 2.9 times as much to the upside, and the downside 2.6 times as much, and the 9 day 1.3 to 1.7, and the 3 month, which is 90 days, is 0.06 on both sides. We live in that 45-day range. And the 45-day range is very different because the 45-day range is probably, somewhere, I'm not sure why they didn't put it in here, but the 45-day range is probably somewhere in kind of like the
Could be a lot lower, right?
Yeah, it's going to be a little under 1 to 1, right around, whatever. But my point is that it's really interesting to see how much. That's why people love and hate the 0 and 1 DTs, because you're basically playing triple leveraged. Let's go to the next slide. So there's more. When there's a large up move in implied volatility, at least 5%, the whip on the 1 day increases to nearly 5x. So what that means is the bigger the volatility increase. Now, what day did we move up 10% this week? What day was that?
That was just.
Was that 2 days ago? Was that yesterday or two? I'm spacing out now.
Well, we did it both days pretty much. On the 3rd, which was 2 days ago.
2 days ago, we were up almost 10%, wasn't it? Or a little less than that, 8% for the day.
Yeah, we went from 17 and change to 20 and change.
Right.
And then yesterday we went from, a low of 18 and change to 20 and change. So you almost had them back to back. You had a 10%.
Yeah, and so the point and the point they're making here is pretty accurate yesterday too, because yesterday, on a big down day in the VIX, it dropped over, 5x. We're down over 5 or almost 6%. And the day before was up almost 7 or 8%. And so the concept here is that when there's a large up move in the VIX, at least a 5% up move, the whip on any 1 day is nearly 5x of what it is on a slow day. And when there's a big down day in the VIX, the 1 day drop by the same amount, which suggests that 1 day vol goes up faster, but tends to stick high before coming right back down. So because people get scared, but then it comes, we're only talking about 1 day here. So it comes down, very fast, just not that day. So the 1 day moves 5 times as much to the upside. And when it goes down by 5%, it could be as much as 1x. And then the 9 day 1.1 to 1. And then the 90 day, is about equal, which is why you see when you go out longer in time, you just take a lot of risk off the table. Yes. It's just a different game.
Yep.
It's just a different game. Let's go to the takeaway slide. Similar to the effect in the yield curve, there is a whip effect in implied volatility depending on duration. Short-term implied volatility moves of between 3 to 5 times the magnitude of a normal 30-day VIX, with the largest whip effect occurring when volatility goes up. The convexity of the whip is very concentrated and at the 1 day duration, very concentrated at the 1 day duration, while the 9 day implied volatility moves nearly at the same pace as the 30-day implied volatility. So the takeaway from this is that there is a lot of risk in the 0 and 1 days that is very tied to what's happening volatility wise for that day. And you can see it happening today. The flip side of that is that if you go out longer, you pretty much take away a lot of that volatility whip. It's gone.
Yeah, no surprise there, but the equal movement in both directions, I think, was kind of, not surprising, but interesting to see.
Yeah, it was a really good piece. It's something different. Zero volatility, we've done a lot of studies on this, so we just keep trying to mix it up and find more and more stuff to talk about. It's good.
Very good, very good. I got breaking news for you, Sadnov. Mr. Sheridan is still in line to get his bagel, and he does not want to get out of line in New York, so he can't come on the show right now. But that means we can go to your phone calls. We'll have almost a half an hour for your phone calls, so give us a buzz, 855-238-2789 or 855-BE-TASTY. We'll put the number below in just a moment. Come and torture Sosnoff with as many questions as you can. I want to hear from you. We'll be back in 90 seconds. Tasty Live.